Thanks, Peter.
It's always great to get your insights. It's now time to assess earnings season so far and find out what companies look like good value with the Montgomery Fund's 2IC, the Lieutenant, David Buckland. Thanks for joining us, David.
Pleasure, Peter.
OK, mate, to put it in that terrible term that school teachers always warn students not to use, winners and losers, that's what you want to talk about. Who have been the winners so far?
Well, we've had a handful of them. Peter, we've had those handful of internet stocks such as car sales and real estate have done particularly well. Certex have come out with a very, very good volume announcement for the December quarter. AGI, that's Ainsworth Group, are forecasting their earnings for the December half year to be up 50%. CCP, which is Credit Corp, seems to be coming out with good numbers. And one or two others, such as G8 Education, has made a very good acquisition. So I'd say there's probably about 10 stocks who've either reported or guided so far, Peter, and they've guided much better than consensus forecasts. OK, but the most important thing for my viewers is, all right, this has been the show and tell, but when you and Roger and the team start doing the number crunching, is there a company or two there where the intrinsic value has improved because of what you've seen compared to the market price, and therefore it's a buy? Yeah, I think JB Hi-Fi is one, Peter, where the same source sales are up about 3%. The actual sales are up about 6%. We haven't seen what that will do to earnings, but we think it'll increase their earnings number because it's only guidance so far. But it'll increase their earnings number by about 10 percentage points. And our valuation on JB is about $23, and that's traded sub $18 recently. So we think where you've got something like a $5 margin between sub 18 and 23, a situation like that looks pretty exciting.
Yeah, without anything else, mate, that passes the stringent Montgomery test?
Well, I'd have to say ANZ did get down below $30 recently, and they came out with a fine December quarter. I accept that a lot of that December quarter was because of reduced bad debt provisioning and doubtful debt provisioning, but 13% up year on year was a good number, and I think sub $30 that looked like quite a good opportunity. Our valuation there is north of 33, so that sort of started standing out as well.
Yeah, that's the reason why I courageously wrote the story that it's time to buy banks, mate. And I'm not always that courageous. All right, so any other winners you want to talk about before we start talking about the poor old losers?
Look, I think just one other was car sales. We quite like that result, and that got down to sort of sub $9 fairly recently, and our valuation on that is sort of probably north of 11. So again, just sort of trying to pick the eyes out of those little opportunities there, Peter.
OK, great. Let's go to the other side of the ledger. What did you see that kind of concerned you? Well,
what I found interesting, Peter, and there's been a lot of academic research on this, and that is that when a stock disappoints, it normally performs about twice as badly as when a stock exceeds expectations, i.e. something exceeds expectations quite noticeably, it rises maybe 10% over 3 or 4 days. When something disappoints, it gets slaughtered, down 20%, down 30%, down 15% would be quite the norm. So, for example, we saw a couple of the retailers such as what's an example here? The Reject Shop would be one example. Logicams is another example. Bradken, Boom Logistics, well, obviously Forge, the fat lady sung there. SUL, which is another retailer. So there's a handful of stocks either in the resource service sector or in the sort of the retail sector that really did disappoint in their guidance, and they fell on average 20%, where the good ones, the winners, went up about 10%.
Now, but the fact that they sell off so badly, can it also mean that makes them a buying opportunity? Because it seems so exaggerated.
Yeah, so take the Reject Shop as an example. Its revenue was actually up 18 percentage points, which was great growth. And admittedly, that's because Jan Cameron's Adventure Group had sort of gone into administration, so they picked up a certain amount of market share. But the problem was their earnings only grew about 5%, so they had quite bad compression in earnings. And that was probably because they moved away from their basics of selling really cheap stuff. and they just didn't sell much less cheap stuff. Now, the share price responded aggressively and fell from over $17, which we fortunately exited our holding at, and then declined all the way to about $10.50. Now, the question at $10.50 you ask yourself is that compression in margins permanent or temporary? And obviously a certain amount of analysis is required, but if it's only temporary, then at $10.50 it could actually end up becoming very good value.
Well, here's a more provocative question. Have you guys bought at 10.5?
Yeah, we certainly had an order out there, but it only traded there for a very short period of time, and since jumped to about $11. So you've got to be very disciplined on your buy side. But I think what happens is if you make an assessment it's not permanent, it's only temporary, then there can be opportunities had. I know another one that you were looking at, Peter, was Logicams. It's only a very small West Australian-based company. It's a contractor. It has an absolute blue chip portfolio of clients. Rio, BHP, Santos, Origin Energy, Oil Search, ConocoPhillips, Chevron, to name a few. And its business model is that it has revenue of about $130 million. It's a small business. Its margins at the EBIT line have been about 11%, so it makes about $14.3 million. And the year to June 2013, that was sort of 4.3 in the first half and then 10 in the second half. And suddenly, after saying they had an absolute record tender book, they said that their December half year would be closer to 3 versus the 4.3. So the market slaughtered them and said, OK, your earnings didn't meet expectations by 30%. We're going to push you down by 30%. Now, the fact remains they have a blue chip portfolio, and one wonders at $1 from $1.45, is this just temporary or is it permanent? Now, again, if it's temporary, these are the sorts of things you should look at. I mean, this is a business with a strong balance sheet, cash in the bank, blue chip clients and very, very good management.
Yeah, so what you're saying is that if people listen to us, bought Logicam, it's fallen, on your assessment, it's still a good company.
Yes, and what I have to say is that with any of these opportunities, you've just got to try and assess, is it temporary or permanent? And if it's permanent, you just walk away and put them in the sin bin. But if it's temporary and it requires more work, and what you simply say is, look, it's gone, in this example, in Logicam's example, it's gone from $1.45 to $1 really in sort of really 2 days. And at $1, you just say to yourself, look, this has the capability again one day of earning 16 or 17 cents, possibly even more. It's on a PE of sort of potentially 6 or 7 times and a dividend yield potentially of sort of 9%. Now that's only potentially, but I'm simply saying there lies the opportunities.
Okay, mate. Thanks for joining us on the program. See you in a few weeks' time.
Great to see you, Peter. Thank you.